Okay, well, Dean Kim is now joining us, head of global research product at William O'Neill. Dean, good to have you with us here. Technically, the S&P and the NASDAQ, are they going to see a bigger dive from here?
Yeah, we're kind of in a precarious situation at the moment. And today, we saw the U.S. market being under pressure as the 10-year bond yield is now elevated to 4.9%. So now we believe that there's a real possibility that the yield can get up to 5.25. And so both S&P and NASDAQ are now below key moving averages, but still above the 200-day moving averages for now. We do need to see both indices sort of bounce. But, given the hawkish view of the Fed and also the bond market being elevated, it may be difficult in the short term.
Dean, morning. We're getting conflicting messages about where the monetary policy might be headed. On one hand, you've got U.S. inflation, which is moderating. But on the other hand, you've got relentless rise in the U.S. 10-year yield. And you're saying it's possible we could head back to levels of 5.25, something that we had seen, I think, way back in 2006. Where is monetary policy headed? And in case in the November meet, we do get a bit of a dovish signal from the Fed, how would the markets react?
Yeah, I think the problem with the bond market situation is, there's just not enough demand for bonds at the moment. So last week when the Fed had the auction, the uptake wasn't that strong. As a result, the yields went up. So actually, this may be a good tool for the Fed because the bond market is doing the job for them. The financial conditions is getting very tight in the U.S. As an example, mortgage is now heading up towards 8%. Pre the rate hiking cycle, we were at around 2%. So for the consumers, they're going to start to feel the pinch. And in that way, with financial conditions being so tight, the Fed can actually stay the course and keep the rate higher for longer and not necessarily raise rates. But the market is expecting one more rate hike. So that's on the table still.
All right. Hi, Dean. Good morning. Could you tell us what about the Indian markets? Normally you do a bit of techno funda, so to call it, and you give us some support levels on the Nifty. If you've got a level for the Nifty Bank, because, that's been the big underperformer for us. Even in this month, the Nifty is more or less flattish. The Nifty Bank is down nearly around 1.5% to 2%. So your view on the Indian markets and those levels you're tracking? Yeah,
so in terms of the sensex, I think the next price support is at the 100-day moving average, which is 1% below. Currently, it is testing the 50-day moving average. So if we can bounce from here, that would be great news. But should we breach that level, the 100-day moving average, which should act as strong support, is about 1% away. Now, in terms of the private sector banks, HDFC, chart-wise, looks the weakest. And actually, even the public sector banks, they're kind of testing the short-term moving averages. And we do need to see a bounce here. Otherwise, they may be testing the 50-day moving average. So I think the next few trading days will be quite critical.
Dean, you have a view on oil technically again? I mean, it was before this thing broke, the conflict broke, oil actually was on the mend. It was coming off. Since then, it's added about $5 or so. What's your sense?
Yeah, I think oil, we look at it as a barometer of what's going on in the Middle East. I think if there's going to be escalation in terms of the war, unfortunately, we're probably going to see the oil price spike. And so if we get up to 90, beyond 90, we're going straight to 95. But in terms of currently where oil's sitting, it's at around 87. We see next support at around 85, which is the 50-day moving average. But I would, stay close to the conflict that's going on in the Middle East. Escalation is going to drive oil prices, unfortunately.
Despite India being a preferred country in the emerging market basket, the FPIs continue to sell in the Indian markets. With financial conditions remaining tight in the US markets, do you expect FPI selling to persist?
Probably we're going to see, money flows out of emerging markets. Indian market is by far the best market in emerging markets and perhaps on a global basis. But we may see some selling pressure. When I look at Asia, the AAXJ, for instance, there's a lot of resistance towards the 200-day moving average. And right now it looks like they're going to be testing the bottom of the base that we're currently in. And so the FDIs, basically, they're moving money out of emerging markets, and perhaps they're going to move more into the bond market as yields become more attractive. So that's the dynamic that we're dealing with.
Okay, all right. Yeah, that seems to be the case because the bonds are looking a little bit more attractive at current juncture globally, actually. But final question, Dean, before we let you go, there'll be some outflows from emerging markets. But within emerging markets, India still stands out, or in the near term, given the valuations, given the data points that are coming in, yesterday the GDP number coming in from China as well looked a little bit better. Will you think that, in the near term, China could outperform for a couple of quarters?
I think China's GDP was good news, but, it's interesting that the market didn't react that way. The market actually sold off. And so that's kind of concerning. But I always, come back to India in terms of its fundamentals. You have many companies that's generating double-digit earnings growth. A lot of, organic growth being driven within the country. I think India is a safe haven amongst the emerging markets. There's a lot of stocks. Of course, there's a lot of extended stocks, but there's a lot of opportunities as well.
Okay, on that optimistic note, Dean, we'll thank you. Thanks so much for joining in. India could be the preferred market, but in the near term, maybe a flight to safety, which is bonds in comparison to equities globally, is Dean's call. And we're very close to a support level on the sensex, 1% away from that 100 DMA.